AT&T or Verizon, which high yielding stock is the better investment for the future and which one is better right now in terms of value? We're going to compare every single financial metric between the two companies to really understand which one over the next 5 to 10 years is the better investment, both with very high yields. AT&T starting at 7.5%, Verizon at around 8%. We're also going to see what are the institutions doing. Are they favoring Verizon or AT&T? Which one are they buying more of? We're going to compare the historical performance of them, total return over the last 5 years. And we're also going to have a look at the balance sheet of both companies. Which company holds that stronger balance sheet for those dividends and for future growth? Now, we're also going to take a very quick look towards the end of the episode at the valuation model for Verizon as well as AT&T to see which one is also better valued and gives you a higher margin of safety. Now, with AT&T, we can see it is down around 21% year to date, trading towards the mid to lower end of the 52-week range. It does offer a yield of 7.5%. And as we can see, shareholders who have been holding the company over the last 10 years would have seen a negative 46% return on investment. Now that is incredibly poor. And for an investment like AT&T, if you are locking in that yield today at 7.5%, you want to be thinking that this company is very cheap. You're going to be doubling your money at least over the next 10 years with that yield on cost in double digits. Well, how does this compare to Verizon? Well, also Verizon down 16% year to date. It is trading towards the mid to lower end of the 52-week range with a slightly higher yield of 7.9%. Now, over the last 10 years, investors would be down 31%. So again, another poor investment over historic terms. Granted that this doesn't include those dividends reinvested, not what you want to be looking at. So again, if Verizon is what you are looking to invest in, you have to be thinking you'll at least double your money over the next 10 years. And again, see that yield on cost in double digits. Now, both of these companies did have a very strong quarter report, with both of them beating on the top line revenue as well as earnings per share, as well as showing some very strong signs for that increasing free cash flow. So let's move on to the institutions to see what are the institutions doing. Well, we'll start off with AT&T. 53.65% is institutional ownership of the company. Now, 5.33 billion worth of shares have been sold over the last 12 months, but a significant amount more, 23.79 billion worth of shares have been bought. So institutions are liking AT&T and have been putting their money where their mouth is by buying more. And we can see their latest increase, around 15 billion worth of shares in the company in Q2 of 2023. So institutions do like AT&T. Now, when we compare this to Verizon, we have a slightly higher institutional ownership at around 61%. Likewise, there is some selling by institutions at around 10.64 billion, but we can also see a significant amount more, 22.17 billion worth of shares have been bought. So institutions like AT&T are seeing value in the company, buying more shares than they are selling. And we can see again in Q2 of 2023, around 7.5 billion worth of shares have been bought. So institutions are seeing value. Do remember though, we're not looking at what institutions do and taking that and copying them. We have to perform our own due diligence as well. So comparing the two companies, what we can see, the market cap of AT&T slightly lower at 106 billion versus 140 billion. And year to date, when we compare a total return basis, we can in fact see both companies down. However, Verizon has a slightly better return at negative 10.5%. versus AT&T's negative 15.62%. Now, if we were just to compare that to over the last 5 years, which company has outperformed, we can see again over the last 5 years, both companies are negative in terms of their total return growth. AT&T, however, slightly better at a negative 8% versus Verizon's negative 24%. So based on historic performance over the last 5 years, AT&T the clear winner, but when you do take a look at them both being negative, it's not the greatest investment for historic investors. And as always, historic previous performance is never indicative of the future, so we have to look forward to see what we are expected to gain. So if we take a quick look at their balance sheets to compare before we jump into the financial metrics, and we start with AT&T, if we take a look at the health of the company, they have 5.2 billion of cash in December 2018. Latest quarterly report around 7.5 billion. So they have been increasing their cash balance over the last 5 years at around a 50% increase. Now, when we compare that to the movement in total debt, what we can see, 179 billion in 2018, latest quarterly report showing 155 billion. So very positive to see. Not only are they increasing their cash balance, but they're also decreasing and paying off that total debt by quite a significant amount, around 24 billion. So very positive to see for AT&T. We will look into the net debt to EBITDA metric as well for both companies. Now, when we compare that to Verizon's balance sheet, we take a look at their cash balance in 2018, 2.745 billion. And then in their latest report, again, we can see a very strong increase to around 4.2 billion. So like AT&T, Verizon are also increasing their cash balance from the last 5 years. Now, numerically and directionally, if we take a look at Verizon's total debt, we see they have 114 billion in 2018. And in fact, the opposite of AT&T, a significant increase to 172 billion. So they are sitting on a lot more debt than they did 5 years ago. Whilst their cash balance is increasing, their total debt is moving in the wrong direction. But we will take a look at their net debt to EBITDA metric to understand how this affects the company and their dividend. So jumping into now the financial metrics, and straight away, AT&T's dividend safety sitting at a 60, making it borderline safe. We can see Verizon slightly higher at 70, making it safe. So we do see this distinguished factor between the two, and we'll take a look at some metrics to see why that is. And we can see, as mentioned, Verizon does have a larger market cap and also offers a higher dividend yield. So now let's take a look at some recession metrics very quickly for those that see a recession looming. Both companies, as we can see here in the last recession, 07-09, in fact, increased their dividends. Also, interestingly, both had roughly the same recession sales at around negative 1%. However, AT&T slightly performed worse at a negative 45% return, whereas Verizon slightly better at 38%. So not too much to differentiate the two companies so far. Now we get on to dividend growth, and AT&T investors know that their dividend growth had to be reset due to the fact that they did get that dividend cut. And if we take a look at the last 5 years, negative 11% due to that cut being factored in. Last 20%, 0%, so very poor, especially when it's below that 4% inflation rate that I consistently say you need to get higher, given the fact that the US inflation rate was 4% over the last 40 years. Verizon, a lot better. They have been paying increasing dividends over the last 16 years. Although that 1.9% increase last month was very poor, given it was lower than inflation, it was still better when we're comparing to AT&T's, and a 3% increase on average over the last 20 years. So Verizon, based on dividend growth, is the winner here. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. So we see that both for AT&T as well as Verizon, so both showing signs of undervaluation. And the same can be said with the forward PE sitting below the 5-year average for both companies. And as mentioned at the beginning of the episode, both are trading towards the 52-week low. But bear in mind, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, typically we have the earnings payout on the show purely because investors I know do like to look at that. However, we focus our attention on the free cash flow due to the fact that earnings is susceptible to manipulation by management through their accounting. And we do run through examples in other shows. So if we jump straight into that, what we like to see personally, for the majority of companies we invest in, around 60% or low, as it means management have the ability to offer those double-digit dividend increases. And now when we compare the two, AT&T, over the last 5 years, we can see sitting around 60% or low. We see 64% in 2022, but with 2023, we are expecting 45%, so even lower. So that is quite positive to see. And even if we go back the last 5 years then, other than 2014 where we see 97%, it has been at a fairly decent rate. Now comparing that to Verizon, we do see quite some inconsistencies. 2016, 228%. And this is one of the reasons why I say better to focus on the free cash flow. Because in 2016, we could denote from this that effectively management are paying out more in dividends than they are generating free cash flow. Whereas 2016 for Verizon under the earnings payout, we would be quite happy as it's below 60%. Now focusing on their free cash flow over the last few years, in fact, we do see above 100%, which to me is a red flag indicator, essentially showing they are paying out more in dividends than they're generating in free cash flow. It does help to see the next, well, essentially 23 coming down lower, but I would say this is a slight red flag indicator and probably why we only saw a very small increase in the dividend. So based on the two informations we have in front of us, we would say AT&T is the winner for the free cash flow payout metric. Earnings per share, again, data available for investors that like to take a look. Based on the free cash flow for AT&T, 253 to 173, it is going in the wrong direction, not the greatest metric that you want to see for a company, but do note from before that in 2021 it was higher and you would have seen growth. So again, some inconsistencies. It is expected to pick up, but not the greatest growth you want to see. Verizon 829 to 248, we also see a negative 683. So again, it is also decreasing like AT&T. So for this one, I would say they are roughly the same, so neither of them get the point. Sales growth 3 to 7% is what we like to see at minimum, due to the fact that if inflation is at 4% and the company is barely able to hit that, then in real terms they are losing revenue. With AT&T, we do see it go from around 129 billion to 121 billion. So we can see very, very minimal growth over the last 10 years. In fact, it has declined, although you could argue some of that is related to the spin-off and therefore it may make this slightly irrelevant. With Verizon, again, not much growth over the years, 121 billion to 137 billion. So given the fact that there was that AT&T Warner spin-off, we can say this is a draw. Then moving on to the shares outstanding. Now, we love it as investors when companies do share buybacks, returning excess cash to our pockets. Both AT&T and Verizon have done share issuances, which in fact dilutes your position as a shareholder. I would say Verizon wins this. From 2014. It has remained relatively stable, whereas AT&T do tend to issue shares every few years. So again, Verizon wins that very slightly. ROIC, now one of my 7 golden dividend metrics. What we look for is 10% or more. The reason for this, it means management are able to effectively allocate their capital. And what we can see, AT&T realistically haven't really hit that 10% over the last 10 years other than 2013. Whereas Verizon, they do manage to hit that every single year. So if Verizon wins in this case, the only thing I would say to be aware of, it has started to decrease quite consistently from 2015. So do keep an eye on that 23 figure. Then we move on to the operating margins. And again, for the free cash flow and operating, we have a minimum of 14 and 7. What we can see, AT&T does seem to do this very well. Likewise with Verizon. On the free cash flow margin, AT&T every single year above the 7%. Verizon a bit more inconsistent. We do see that negative percentage in 21 and 2016 and 2017 where it is lower. So I would say whilst these two are very similar, if I had to go for one business with the better margins, I would have to go for AT&T. Now, one of the most important metrics which does directly correlate to those borderline safe and safe dividend scores that we see here is the net debt to EBITDA. What this essentially means is the number of years it would take management to pay off all of their debt net of cash on hand. And 3.5 is really the maximum we like to see for the telecoms industry. AT&T has been below that every single year. To be fair, likewise, we see that with Verizon. And the issue we had with Verizon was that they were increasing their cash position by only a very small amount, whereas we saw their total debt increase massively. Whereas AT&T, even though they already had a huge total debt, they were still decreasing that debt amount year on year. And we can see here, though, for AT&T, 3.47 in 2022, 3.37 for Verizon in 2022. So roughly the same. 2023, it is expected AT&T to drop to 3, whereas Verizon around 3.13. So both are very, very similar. I would say, in my opinion, though, right now, both dividends are safe. But I would say it's a very, very similar score. So to recap, in my opinion, there are some pros and cons with each company, AT&T and Verizon. So realistically, I wouldn't say there is any clear winner based on the metrics. But what I would say, the way to choose which one is the better valued stock is to run it through our stock valuation model now to see which company is better valued and gives us the higher margin of safety. As always, if you do enjoy the content, value is being provided, do hit that like button, do hit that subscribe and bell button to be continually notified of these videos. And if you want to run your own companies through to get your own intrinsic value and acceptable buy price and your investor margin of safety, do click on the pinned comment below. Now, typically what we would do is we'd run through each valuation model. We have Graham's valuation, we have the multiples valuation, we then have the dividend discount and the DCF model. But for timing purposes, we will just jump straight into the final product, so the valuation prices that we see. So the intrinsic value that we calculate for AT&T coming at $22. Now the current price sitting around $15 with a margin of safety. What we would typically expect would be a minimum of 10% if you believed it had a wide moat, strong financial metrics, good forward-looking data. But with AT&T, you would definitely justify higher. A 20% margin of safety would be a buy up to $17.57, a 30% margin of safety up to around $15.38. So what we're essentially saying is now if you were to lock in a price of AT&T up to $15.38, you would be getting a 30% margin of safety. And we can see here Wall Street expect the price of AT&T over the next 12 months to hit $19.27. So right now AT&T is giving us a 30% margin of safety at current price. Now when we compare that to Verizon, what we have here for Verizon, and we'll take a very quick look, is an intrinsic value of $36.74. Now with Verizon, its current price is around $33. If you were looking at a margin of safety of 10%, your acceptable buy would be roughly up to $33, which is just a few cents shy of the current trading price. So as we can see with AT&T, you are locking in a 30% margin of safety in current price, whereas with Verizon, you are locking in a 10%. So Verizon does seem to be a bit more expensive, whereas AT&T right now, you are getting a larger margin of safety. And we can see here, Wall Street also expects some upside to the Verizon stock price of around 20% up to $39.18. So to recap, I would say in terms of the financial metrics that we ran through, it seems to me that they are very close. On the balance sheet side, I do prefer the direction that AT&T are moving in, whilst they are increasing their cash balance, very similar to Verizon. We are seeing in actual fact that Verizon are increasing quite considerably their total debt over time, whereas AT&T, even though they have a lot of debt right now, they are paying that off every single year. And when we compared their stock analysis, AT&T, you are locking in a 30% margin of safety versus a 10% margin of safety on Verizon. So overall, in terms of which is the better stock, I would say they are very, very similar. Which is the better valued stock right now? I would have to go for AT&T. As always, if you enjoy the content, value is being provided. Do hit that button. Smash that like button, hit the subscribe and bell to be continually notified. If you want to jump in, join us on the Discord where we're talking about all buys in the market last week and for the future weeks. Do click on that Patreon link below. And as always, if you want to grab a valuation model where you want to run your own companies to get your own intrinsic value and acceptable buy price given your margin of safety, then do click on the pinned comment below. As always, have a great day. Catch you on the next episode and take care.